For most people, holding cash feels safe. It's liquid, accessible, and stable. You can see it in your account, touch it in your wallet, and know it's there when you need it. But here's the uncomfortable truth. Holding too much cash is one of the most expensive mistakes investors make. Why? Because while cash doesn't fluctuate in price, its value erodes silently over time. Inflation, the steady rise in prices, eats away at your purchasing power year after year. You may not see it on your bank statement, but make no mistake, if your money isn't growing, it's shrinking. Let's break that down. Imagine you have $10,000 sitting in a savings account earning 1% annual interest. Meanwhile, inflation runs at 4%. On paper, your balance increases to $10,100 after a year. But in reality, what you can buy with that money is now worth only $9,700 compared to last year. You've effectively lost $300 in purchasing power just by standing still. That's the hidden cost of holding cash. Now, let's go deeper into why this happens and what smart investors do differently. Inflation is a natural part of economic growth. As demand for goods and services rises, so do prices. Central banks target mild inflation, usually around 2–3%, to encourage spending and investment. The problem is, when inflation rises faster than the interest earned on your cash, you're losing wealth in real terms. This means the longer you hold cash without putting it to work, the more opportunity you lose, not just from inflation, but also from compounding that could have been growing your money. Here's an example. If you leave $10,000 in a savings account earning 1% per year for 20 years, you'll have about $12,200. But if inflation averages 3% per year, your money's real value will drop to roughly $6,750 in today's dollars. In other words, your purchasing power has been cut almost in half. Meanwhile, that same $10,000 invested in a conservative index fund averaging 7% returns per year would grow to nearly $38,700. Even after adjusting for inflation, you'd still have around 3 times your original buying power. The key takeaway: cash feels safe because it's stable, but stability doesn't mean security. Smart investors understand that wealth isn't about avoiding risk entirely, it's about managing it intelligently. They know that not investing is actually a form of risk, the risk of missed opportunity. Let's look at how this plays out psychologically. When markets become volatile or uncertain, many people move their money into cash to wait it out. It feels smart in the short term, you avoid the dips. But when the market recovers, you miss the rebounds. Historically, most of the stock market's biggest gains occur during very short periods following major downturns. Miss just the 10 best days in a decade, and your returns can drop by more than 50%. Cash sitting on the sidelines can cost you far more than temporary volatility ever would. That's why smart investors stay invested even through turbulence. They keep enough cash for emergencies but make sure the rest is working for them. Now, let's talk about how much cash you should actually hold. The general rule of thumb is to keep 3 to 6 months' worth of expenses in an emergency fund. That's your safety net. Anything beyond that should be allocated toward growth or income-generating assets. For example, keep 5 to 10% of your total assets in cash for liquidity. Use the rest across diversified investments like index funds, bonds, real estate, or dividend stocks. If you're risk-averse, consider short-term treasury bills or inflation-protected securities tips instead of cash. These alternatives maintain liquidity but also preserve or even grow purchasing power over time. Let's bring inflation into sharper focus. If inflation averages just 3% a year, prices will double roughly every 24 years, thanks to the rule of 72. That means $1,000 today will buy only half as much in 24 years. If your savings aren't growing at least at the same rate, you're guaranteed to lose wealth. In the last few years, inflation has surged globally. In many countries, inflation rates of 6 to 9% have become common. That's devastating for anyone sitting on large cash balances. Even in high-yield savings accounts paying 4 to 5%, you're barely breaking even after taxes. Here's where opportunity cost comes in, the most overlooked concept in personal finance. Opportunity cost is the benefit you miss out on by choosing one option over another. By keeping money idle in cash, you're giving up the chance to earn higher returns elsewhere. If you could earn 7% in the stock market but choose to keep money in a 1% savings account, your opportunity cost is 6% per year. On $50,000, that's $3,000 in lost growth every single year. Over time, that adds up to an enormous amount of lost potential wealth. Let's put it in perspective. $50,000 invested at 7% over 20 years grows to around $193,000. Left in cash earning 1%, it grows to just $61,000. That's a $132,000 gap, purely from opportunity cost. Smart investors never ignore this. They understand that every dollar sitting idle is a dollar that's not compounding. Now, this doesn't mean you should put all your money in risky assets. Balance is key. The goal is to find the sweet spot between safety, liquidity, and growth. Here's a practical approach: keep your emergency fund liquid. Invest your medium and long-term money in diversified assets that beat inflation. Periodically rebalance your portfolio to stay aligned with your risk tolerance. You can even use cash flow investing strategies like dividend stocks, real estate investment trusts REITs, or peer-to-peer lending to turn idle money into income-producing capital while maintaining some flexibility. Let us also address one common misconception: I'll wait for the right time to invest. This is one of the most dangerous forms of procrastination in finance. Timing the market feels smart, but it almost never works. Even professionals rarely get it right consistently. What actually builds wealth is time in the market, not timing the market. If you're waiting for the perfect moment, you might end up waiting forever while inflation quietly erodes your savings month after month. Instead, use a system like dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. It removes emotion from the process and takes advantage of market fluctuations automatically. Over time, you buy more shares when prices are low and fewer when they're high, reducing your average cost. Now let's touch on the mindset shift that truly separates savers from investors. Savers think in terms of safety and preservation. Investors think in terms of growth and optimization. Savers say, "I don't want to lose money." Investors say, "I don't want to lose buying power." That difference in mindset changes everything. Because in a world where inflation is constant, doing nothing is not neutral, it's negative. Sitting on cash guarantees loss over time. Investing, even conservatively, gives your money a fighting chance to stay ahead. The key takeaway is this: holding some cash makes sense for liquidity and emergencies, but holding too much guarantees erosion. Inflation is invisible, but relentless. It doesn't crash suddenly like the stock market. It eats away quietly, every single day. To protect yourself, your money must work harder than inflation. That means choosing assets that consistently outpace price increases, whether that's stocks, bonds, real estate, or even high-yield alternatives. Let's summarize with a few pro tips. Keep only necessary liquidity. The rest should be invested. Understand the real return, not just the nominal one. Inflation protection is part of risk management. Don't confuse stability with security. The best hedge against inflation is ownership of productive assets. In closing, remember, your wealth isn't measured by how much money you save, it's measured by how effectively that money grows. Cash feels comfortable because it's familiar, but comfort and growth rarely coexist. So take a step back, evaluate your balance between safety and opportunity, and ask yourself, is your money working as hard as you do? And as always, this content is for educational purposes only, not financial advice. Always do your research or consult a licensed financial advisor before making investment decisions.